One of the first things we can do to set up a statement of cash flows is to analyze some of the selected accounts. So what we have here is a comparative balance sheet for 2017 and 2018. So these will be our beginning and our ending balances. So the first account that we want to look at are any of our long-term assets. So we're going to go over here to our assets section of our balance sheet, go to long-term assets, and the first one we see is plant assets. So we're going to put a beginning balance here of $216,400. That's the 2017 ending balance. And then we're going to go and get the ending balance of 2018 and put it right here on our T account here for our ending balance. Now these two don't add up, so we need to make sure that we read any of the additional information that we have here. And it says, assume, we want to compute the acquisition of plant assets, assume it was for cash, assume that they disposed of plant assets at book value, and the cost and the accumulated depreciation of the disposed asset was $47,900. So we're going to put that right over here. This is going to represent the disposal. So if a plant asset is being reduced, it will go on the credit side. So $216,400 minus $47,900 does not equal $260,500, so that means something else must have happened over here, and that was an acquisition. So when we solve for the unknown there, we get $92,000. So that means we acquired $92,000 worth of plant assets that year. Okay, now we keep going further down and we see investments. We had investments there. So they started at $73,000 and they ended at $96,000, and we didn't have any other information for these investments, so that means we had a new investment for the year for $23,000. This would be a cash outflow because we purchased, so would the acquisition of the plant asset. Both of those are outflows of cash because they were new things that we purchased. Next thing we're going to look at is long-term debt. So we go down here to long-term liabilities. We had one long-term note payable. We started out with $69,000 at the beginning of the year, and we ended up with $61,000 by the end of the year. So we know if we didn't have any new long-term debt, which it says we assume that they only had one long-term note payable transaction, then that means that something happened over here. So if debt got smaller, that means that we paid off the debt for $8,000. We made that note payable smaller by $8,000. So if we paid off a note, that's going to mean a cash outflow also of $8,000. Next, our stock transactions. So it says compute the issuance of stock only if they only had one common stock transaction during the year. So we know if we had a beginning balance of $34,000, an ending balance of $45,000, and we didn't have any retirement of stock, that means we must have issued more stock for $11,000. Now if we issue stock, remember the offsetting entry to that, the debit is a debit to cash, because when we issue stock, we do that to get money. So this is going to represent a cash inflow. So cash is coming in for $11,000 because someone purchased stock from us and gave us money. Okay, now the last thing we're going to look at is our retained earnings. Now retained earnings tells us a lot. So when we look at retained earnings, we start out with our beginning balance. It's going to come right off of our balance sheet here. And our ending balance is $290,000. Now this net income would have come off of our income statement, so I gave that to you. Net income for the year was $107,000. So we know that 230 plus 107 is not 290, so that means we must have had a debit over here. And if you'll remember from our equity financing chapters when we dealt with stocks and bonds, when we debited retained earnings, we always did that because we were paying dividends. So that's what goes here. So this is a dividend payment of $47,000. So that would be an outflow. So the offset to that would be credit cash for $47,000. So dividends are an outflow of cash for $47,000. And that's all. Now that you've finished analyzing the transactions, the next thing that we would be ready to do is to do a statement of cash flows. I hope you enjoyed this video, and I hope you enjoy the statement of cash flows.